Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the Profit by Friday podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. Marcus Chen had been watching a stock for 11 weeks. Every Monday morning he pulled up the chart. The stock was not doing anything. Was trading in a tight range between $42 and $45. No big moves up. No big moves down. Just sideways. Week after week. By week 8, Marcus was bored. He had other ideas he wanted to deploy capital into. This one was just sitting there doing nothing. So he sold it and moved on. 3 weeks later, the stock broke out. It ran from $43 to $61 in 5 weeks. A 42% move. Marcus watched it from the sidelines. He had done everything right. He had identified the stock through the clear framework. The score was solid. The fundamentals were strong. The catalyst was real. And he had held it through 8 weeks of sideways action, only to sell 3 weeks before it made the move he had been waiting for. What Marcus did not know was that those 11 weeks of sideways action were not the stock doing nothing. They were the stock doing exactly what it needed to do before it could move. That sideways period had a name. It was a base. And it was one of the most powerful signals in investing. Today you will go deep on what a base actually is, why it forms, and how to read one before a breakout happens. Because understanding this one concept would have saved Marcus 42% of gains on a position he had already done all the work to find. Here is what a base is. A base is a period of sideways price action where stock consolidates after a prior advance. It is not a stock going nowhere. It is a stock absorbing selling pressure and building energy for the next move. Think of it like a spring being compressed. The longer and tighter the compression, the more powerful the release when the spring lets go. A stock that bases for 10 weeks in a tight range has built up significantly more energy than a stock that bases for 2 weeks in a wide range. The base serves a specific mechanical purpose. During an advance, a stock attracts sellers who bought earlier and want to take profit. It also attracts short sellers who believe the stock is overextended. The base is the period where all of that selling pressure gets absorbed. Buyers step in at the same price level week after week, soaking up every share that gets offered. When the sellers finally run out of stock to sell, there is no more resistance. The buyers are now in control and the stock moves. Marcus sold 3 weeks before the sellers ran out. He left right at the moment the base was completing. Now here is how to read a base before the breakout happens. There are 3 things to look for. The first is the depth of the base. A healthy base corrects between 10 and 30% from its prior high. A base that corrects more than 35% is damaged and requires a longer recovery period before it can be trusted. When Marcus was watching his stock trade between $42 and $45, the prior high had been $47. That is a 9% correction. Shallow, healthy. A sign that sellers were not motivated. They were not rushing to get out. That is a positive signal. The second is the tightness of the price action. The more consistent the price range during the base, the healthier the setup. A stock that oscillates between $42 and $45 for 10 weeks is demonstrating that buyers and sellers have reached a stable equilibrium. Neither side is panicking. That tight range means supply is being absorbed methodically. Wide swings within the base suggest instability. Institutional money is not committed yet. The tighter the range, the more confident you can be that smart money is quietly building a position. The third is the volume pattern within the base. During a healthy base, volume should dry up. Lower than average volume during the sideways period means sellers are exhausted. There are simply not enough motivated sellers to push the price lower. When you see a stock trading in a tight range on declining volume, that is the fingerprint of a base completing. Sellers have given up. The buyers who remain are patient and committed. And when the stock eventually breaks above the resistance level at the top of the base, that breakout should happen on volume that is significantly above average. That volume surge is institutional money finishing the accumulation and pushing the price to the next level. When Marcus looked at his chart in week 8, he saw a stock going nowhere on low volume. What he should have seen was a stock with exhausted sellers, tight price action, and shallow correction. All 3 signals of a healthy base in the final stages of completion. Sold the spring 3 weeks before it released. Here is the rule. When a stock you have already validated through the clear framework enters a base, your job changes. You are no longer evaluating whether to buy. You already decided that when you ran it through the framework. Your only job now is to wait for the base to complete and the breakout to confirm. The base is not the stock doing nothing. The base is the stock preparing. And patience during a base is not passive. It is the active application of discipline in the face of boredom, which is one of the hardest things in investing. Amateurs sell during basis because nothing is happening. Investors hold during basis because they understand what is happening. Visit ProfitByFriday.com today. I will see you in episode 9.